Well, how's it going, friends and family? My name is Amos, and it's time for another portfolio roast session. And yes, these are real portfolios that are submitted for roasting or slash review by viewers like you. So what I'm trying to say is if you like what you see and you hear, then you should give it a go yourself by submitting your portfolio through the Google Forms link that's going to be in the video description and pinned comment itself. And if you are new here, here's how it's going to go down. We're going to be reviewing the portfolio as is, and then in the second half, I'll make modifications as if it's my own portfolio in order to optimize it. And I think there's going to be value add for everyone, regardless if you agree with his strategy or not, because the strategy is pretty unique. So, who are we talking about? Today we're looking at Bjorn's portfolio. He's 37 years old and he works in HR. Yes, human resources. He's the guy that you deal with if you break company policy, or if someone snitches on you, or if you fall behind on the mandatory training videos that we all disdain, that we all despise. But between you and me, don't give him a hard time, because I mean, look at that face. He's got a cute puppy face because he's trying to press the retire early button as soon as he can. He's not even passionate about his career field. It's just that it pays well. And at 37, he feels like it's too late to jump ship or pivot career fields. So he's staying put, collecting the paychecks, and he's trying to retire from corporate America. Sounds like a lot of us out here. And a fun fact about Bjorn is that on his Tinder profile, he says that he's 6 feet. Even though he knows full well that he's pushing 5'8" on a good day, and he got a full hair transplant in Turkey about a year ago. I don't know why those facts are relevant for the video, but with that out of the way, none of this is going to be financial or personal advice. All of this is just going to be for fun, entertainment purposes. Does that sound good with you? So what are we working with? 25 different holdings in his portfolio. That adds up to about $200,000. The biggest holding is an S&P 500 ETF, IVV, at 36% of the portfolio. The second biggest conviction pick is Adobe, and then in third place is Ethereum crypto. And as you navigate down the list, it really ranges, right? You have some speculative moonshot bets, and then you also have some boring compounders that your grandpa Joe used to invest into about 40 years ago. So it's kind of like getting a Diet Pepsi at an all-you-can-eat Chinese buffet to balance out the calories. Because if you're going to be downing plate after plate of lo mein and sushi and General Tso's chicken, you might as well get a diet soda, right? That way you can feel a little bit of moral redemption. But anyways, the goal. What's the goal of this portfolio? He wants to turn $200,000 effectively into $2 million by 10 years. I know, that's pretty ballsy, it's pretty bold, but the strategy, it might get him there, the how. So on a high level, it's a barbell strategy. Bjorn has concentrated bets on the AI movement, but not necessarily with the popular names. So as you can see, he doesn't have Nvidia, he doesn't have AMD, he doesn't have TSM. Rather, he's investing into the physical infrastructure that's supporting the gold rush, or I guess the AI movement. He also has exposure into the big blue chip household names that are buy and hold forever, such as like Home Depot, Eaton, he has American Waterworks, and this one's debatable, but Constellation Brands, which is a winery and alcoholic beverage business enterprise. So in a sense, the boring stocks, it kind of balances out the aggressive risk nature of the AI stocks. So it's a barbell. Does that make sense? On one end, it's really high risk, high reward. And on the other, it's like you sleep well at night because they're boring compounders throughout the ages. Now, before we get into the portfolio scorecard where I give actual grades based on different criteria metrics, what are my high-level thoughts and opinions? I'll be honest with you, I love that his biggest holding is in IVV because that helps Bjorn's odds of at least getting market level returns. Because with a strategy that's really aggressive, like the barbell that he's executing, it's lovely to see because for most of us out here, we have no business messing around with individual stocks. For most of us out here, we're better off investing into an ETF like VTI, VU, or SCHD and calling it a day. I'm being serious. That's not financial advice. That's probably the best course of action. If you're going to be messing around with individual stocks, you do have to put the time, due diligence, and effort into making sure that the stocks that you buy, I mean, the other way that I like to describe it is, don't just think of it as buying a stock. Think of it as buying into a business, because essentially when you buy a stock, you're gaining partial ownership of that company. You're a shareholder of that company, that enterprise. So as a business, do you feel confident and strong and bullish about what you are owning as a business, right? Or is it a piece of crap, a dumpster fire? It's burning cash. Don't just think of it as a stock. Because then you go into that gambling and speculative lever pulling casino territory. Because when your framework changes and you start thinking about these as business enterprises, then you start thinking strategically for the long run. Because in the long run, that's how these businesses can compound your wealth. Does that make sense? But anyways, I think it's an interesting outlook that Bjorn is trying to pull off because we're about the same age. But needless to say, we're very different in terms of our investment choices. I think what makes Bjorn's strategy interesting is that for most people, they gravitate towards the popular meme stocks like Palantir, Nvidia, and AMD. I mean, for good reason, right? In the past 5 years, if you put those three together, the ROI is 500%. But in Bjorn's case, he's trying to find the moonshot businesses without the hype, without the popularity, without all of the YouTube videos and articles being written about. And he does this because of the off chance of asymmetric upside, such as 10xing from his initial investment. Because sometimes when we think about the big names, for them to 3x or 5x, it's pretty difficult because their market cap is just ballooned up in valuation. But when you think about moonshot bets that are flying under the radar before all of the hype and attention, the probability of them 10xing, I can see what Bjorn sees. It makes sense to me. And I think Bjorn's portfolio is a reminder that there's no right answer when it comes to investing, right? There's different paths to having a good portfolio. Unless, of course, you go balls deep into day trading and doing options. To be honest with you, that's never the right move. In my personal opinion, that's not financial advice. If you're messing around with options and day trading, dude, that's the quickest way to lose your money. You might win once or twice, or maybe even 5 days in a row, but to execute and pull that off effectively for a whole year or 10 years in a row, it's got to be stress-inducing in my opinion. Now, having said that, let's go over the portfolio scorecard. The first one's going to be the asset and strategy fit. Do the positions and holdings make sense for their goal? And before I reveal the grade letter for his portfolio, do keep in mind that we're evaluating Bjorn's portfolio in the context of his stated strategy. Because, for example, if you're 65, you have gray hair all over your pubes and your armpit hair is white as well, and you're retired, then this portfolio makes absolutely no sense, right? And for you, it might be in the F tier. But that's not a fair assessment. We have to think about it in the scope of what Bjorn wants to achieve and pull off and execute. So with that in mind, I think it's an A-. And turning $200,000 into $2 million, it might sound crazy and difficult to pull off. And it is an ambitious CAGR, but what I'm seeing is with regular deposits and dollar cost averaging, and if his high conviction picks pan out, I think it's possible. I'm not going to give a statistical odd of 70% chance or 20% chance. When you look at his portfolio, you've got the consumer staples and utilities to balance out the data center hardware and satellites. Shout out to Sirius XM. So if the strategy is asymmetric upside from AI while giving you some cushion for the downside, I think it's almost textbook. It goes very extreme in one direction, but also in the other direction as well. So moving on to the next criteria metric, it's the level of risk. So out of 10, 10 being absolutely risky, 1 being a portfolio that's just full of T-bills and bonds, I think it's a 4 out of 10. The fundamentally sound, high-quality, boring businesses in the portfolio, will they allow Bjorn to sleep well at night? Absolutely. But the other half, I feel like you might be better off uninstalling your brokerage app during a market downturn. But jokes aside, that's exactly when I would personally dollar cost average and go big into high conviction picks, because market sales, when everything goes on clearance, it only happens once in a blue moon. Dare I even say like once every few years? But in the past few years, it seems like it happens once every year. That's why regardless of who you are, even if you have sweaty nipples, no nipples, any or an outie belly button, you should have a watch list of stocks that are prioritized from top to bottom, so that if an April 2025 sell-off event happens again, you can pull the trigger and have gunpowder in the reserves, and you can execute in a systematic way instead of being emotional and thinking like, oh, which one should I buy? You already know, like, this is number 1, this is number 2, this is number 3. Just an idea. Low key, I just want to give a shout out to the Patreon, because I do post stocks, the buy prices, the sell prices every now and then up on there. So if you need some ideas, it's up there. But anyways, the portfolio, I think it's moderately safe. At the same time, it's moderately risky with the crypto exposure and concentrated bets on cyclical AI plays. I know right now AI seems to have all the momentum, but historically, anybody that does business in the semiconductor chip space, there's highs and lows. It's just right now, with the hyperscalers and the data center movement, we're in the bull portion of that market cycle. But there will come a time when it's going to dip and reverse in the opposite direction, and their revenue is going to go hard into the red. I'm not going to say when that's going to happen, but eventually, once you load up on enough equipment and chips, you do want to take a chill pill and cool off in the context of how a supply chain and procurement team will be operating. And overall, when we think about the quality of the holdings in his portfolio, there's 25. It's a lot, right? I think it's going to be a B-, and that's good. For me, anybody that's even in the C tier is good. To be in the B tiers, I guess C+, B-, I think that's not bad at all. Some of the holdings I love. It has my seal of approval. Others, not so much. Case in point, I'm not in love with Mattel. I don't like Constellation Brands, and I despise Boeing. Between you and me, I think there's much better alternatives in the market, and we'll go over that here in a little bit. But the AI infrastructure picks, I get the logic. I see what you're gravitating towards, and overall, with just the AI-related stocks, then I feel like it would be a B+, maybe even A-. What I like is Bjorn's thinking outside of the box instead of just going with the masses. Everybody and your ex-wife's boyfriend, they're all invested into Nvidia. Everybody's invested into TSM. But then that begs the question, would he get better returns if he did? If he did follow the masses, right? So just to be devil's advocate right there. But to defend Bjorn, I like his strategy because it doesn't matter who benefits from AI or who has the hype today and who doesn't tomorrow, whether it's Google or Microsoft or which chip is best in class, because I think right now it's up in the air between Nvidia versus AMD. I think it's Nvidia by a huge margin, but the AMD fanboys, they always like to remind me that AMD is catching up. Okay, whatever. Regardless, with Bjorn's portfolio, he's invested into the AI infrastructure. It's going to support the winner, so it doesn't matter who's winning, because the picks and shovels and the physical infrastructure, they'll support that winner. So I really like that. I'm going to be honest with you, I like it. So having said that, let's take a closer look at some of his holdings, and then I'll share with you the modified portfolio. The first one that I want to call out is Sirius XM, and this is one that I covered on the channel not too long ago. I think Warren Buffett daddy, he owns 37 or 38% of all shares outstanding. At this point, I think Berkshire Hathaway is going to do a takeover. But anyways, it's the company that's responsible for Sirius XM and Pandora digital music streaming. Essentially, Sirius XM, it's predicated upon new car sales in the US because you get like a 1 or 3 month free trial. And then afterwards, most people, according to their own marketing tactics, they'll love it so much, they'll continue to pay to use SiriusXM. But in the age of Spotify, Apple Music, YouTube Music, and everything in between, I'm not really bullish on their underlying business operation. But when we think about the satellite real estate, I think that's what's making Bjorn pull the trigger and be bullish about them. They have a pretty sizable arsenal and inventory of satellites that's revolving around space. I mean, right now, I think they're legally only allowed to stream music and podcasts and for talk show hosts. But eventually, who knows? Those satellites might be utilized for different purposes. But We don't know. That's all speculation. When we lift the engine hood and take a look at what's underneath, I'm not exactly too thrilled of what's going on when it comes to Sirius XM. Their top line peaked in 2022, $9 billion. Okay, that's great. But since then, it's been on an inevitable decline year over year. Now, you tell me, when you assess Sirius XM not as a stock, but as a potential business, would you be proud and bullish to own it in your own portfolio, right? It's kind of like, for me, I think about it as like a physical newspaper company going into the internet age. I think their business model had a time and a place, right? Like 10 years ago, maybe even like 5 years ago, but going forward, the digital streaming apps, they're just relentlessly taking market share away from SiriusXM. However, based on my homework, SiriusXM, they only operate in North America. They're not even allowed. Like, I live in Japan, and Pandora is actually my choice, my favorite music streaming service until I moved to Japan. We can't even use it here. And after not using it for 3.5 years or whatever, I don't even miss it anymore. I just default to YouTube. I just go to Apple Music, and I don't really miss it anymore. So they don't have an economic moat, and the territory where they service, it's very small. They're not allowed in Asia. They're not allowed in Europe. They're not allowed in Australia, right? So their top line, it makes sense to me. More and more people are just jumping ship and they're going to the other music streaming services. And something else that's really concerning is their debt situation. I do not think it is sustainable. They have $10.3 billion of obligations on the books. To that is $79 million of cash and cash equivalents. What's the equivalence portion? Money that's highly liquid, like a money market fund, or T-bills, or a CD, a certificate of deposit. So $79 million to that of $10.3 billion. I mean, that's a hard pill to swallow, okay? You scroll down and take a look at their debt to EBITDA ratio. It's a 4.2. No matter how you look at it, their debt situation, it's scary and it's high. However, with that said, when you take a look at their dividend profile, it is pretty juicy, okay? I'm not gonna lie, 5% dividend yield and it's qualified. 38% for the payout ratio, not too bad. But am I bullish on SiriusXM? No. 67% into the red over 5 years. The next one that I want to take a look at is Atlas Lithium Corporation. It's a Brazilian mineral mining company. And let's see what we are working with here. Year to date, we're talking about negative 24% into the red. But what's really crazy is if we zoom out 5 years, then 325% into the green because they were essentially a penny stock. They used to trade for $1.12, and now they're $4.79. Okay, whatever. Great performance, but do the numbers and fundamentals match that of their stock price? Guys, this is really... Like, you tell me, does that instill confidence in you as a potential owner of this business operation? Sometimes they make money and sometimes they don't even make money. In 2024, I'll give them that, okay? That's pretty impressive. $600,000 in revenue. Not in millions, not in billions, $600,000 in revenue. And then in the past 12 months, $180,000 in their gross sales. 2022 and 2023, I'm not sure what's going on, but it says they didn't print cash at all. Actually, if we switch they did not generate any sales in 2022 and 2023. When we think about compounders, long-term, reliable cash flow machines, they're not going to have a revenue situation that looks like this, that is cyclical, that is up and down, and sometimes not even generating a single sale. When you think about a compounder, they need to have a durable moat, a robust business model that's resilient regardless of the market conditions, right? When I look at Atlas Lithium Core, I think this might be a play on the whole EV industry and to power up the data centers. But I do think there's better options out here, guys. And to make it worse, to rub salt into my tiny little eyes, that stings, by the way, they're not profitable. They have never been profitable as a business enterprise. They are burning cash in order to keep the lights on. Immediate red flag. How do I know that? Negative $1.86 of profits per share. golly, man, no matter how you look at it, this company right here, it's an eyesore. And it does not get better as we take a look at their free cash flow situation. The bar chart goes in the opposite trends and direction of what we want to see. Remember, at its heyday about a year ago, they got 600 grand in gross sales. Their free cash flow is negative $31.5 million into the red. So from their operations, they're genuinely burning cash in order to keep it running. Honestly, Bjorn, I'm so sorry, my guy, but like this one right here, I don't see it. I would run away, right? As a potential business, you would have to pay me for me to own them. I wouldn't want to buy them at $4.79. Then again, it's a very small portion of your portfolio. What is it? You got like 2%, so roughly $4,000 into it. So in the grand scheme of things, I guess if it plays out and it 3X's, that's great. If it doesn't, well, I guess that's a $4,000 lesson. It's cheap in the grand scheme of things. The next thing I want to talk about is Mattel. Okay, this is the parent company of Barbie, Hot Wheels, Bob the Builder, and more. They are the rival business enterprise to Hasbro. I actually have two friends that work at Mattel. They're located in SoCal, their headquarters. This is a company that you know what? Let's let the numbers do the talking. Like the valuation, it's kind of cheap. But is it cheap for a good reason? Or is there trading multiple this way because their numbers are hideous? Actually, let's take a look at their performance short term. Year to date, 14% into the green. I think that's the exact same as IVV, which is the ETF of the S&P 500 that he's invested into. No, that one is 17% into the green, so slightly underperforms, but the numbers, again, when we think about a compounder, a sleep well at night kind of a durable blue chip, boring business, this is non-negotiable. We have to see the gross sales be increasing year over year. I do not care if it grows at 0.5% or 10%. With Mattel, it's highs and lows, and it's inconsistent to the point where their stock price is going to follow suit. Is that manifested? Right? Up and down, up and down. It's contingent upon their financial performance. Again, for Mattel, as a business enterprise, would I want to own them? Absolutely not. This is one that does not interest me. And I think if this is categorized as one of the boring compounders in the portfolio, I'm not seeing it, man. I'm not seeing it. Unless, of course, they make this huge pivot into making AI toys that's going to control all of our children's minds, and that's the investing thesis and growth catalyst. Maybe I'm missing it. But maybe their cash flow situation will be better. But I don't think so because it's CapEx heavy because they're in the business of physically manufacturing toys from Vietnam and China. Yeah, CapEx is kind of high, but it makes sense. They make physical products, free cash flow. But do you see what I'm saying? There's highs and lows, highs and lows. They had a peak in 2023, and since then it's on a downward trend. Well, I will give credit where credit is due. At least their cash situation is pretty stabilized. But yeah, with Mattel, I'm just not feeling. But hopefully you understand my intent wasn't to hurt feelings. That was the roasting portion of the video. Now, let's get some constructive feedback. What would I do differently if I had to improve this portfolio because it's mine? I wake up one day, I'm 37, and I work in HR. Now it's my portfolio. My strategy is to do this barbell thing. What would I do differently? Let's hop on over to the next tab. Now, it's important to keep in mind that Bjorn, he does not want to make drastic changes and do a 360 transformation, okay? But this is what I would do, especially for future contributions and if I could sell out of the ones where I just have zero confidence in, okay? Please do keep in mind this is not financial advice, and I'm just talking to myself because I'm literally a crazy idiot. Okay, certified idiot over here, party of one. I really like how the portfolio has exposure to the overlooked, non-crowded bets. Because we all love an HR guy that's easy to talk to and has a stick up his butthole. Having said that, if you look on the left side of the screen, if there's an X, everything with an X, I would personally remove and replace with the companies that are on the right-hand side of the screen. So the first one that I want to address is the Boeing company. They're in the business of manufacturing anything to do with aircraft, but also missiles. And as a military defense company, they are ranked at the absolute bottom for me. Okay, out of the entire industry, to be dead last, speaks volumes, okay? And I'm going to let their numbers do the talking because I know there are a lot of people that like this stock, but for me, I think they're unacceptable. For the past 5 years, 0.3% into the red. Your money would have been relatively flat with Boeing. But why is that? If we take a look at their financial situation, does this look like a high-quality dividend compounder with cheese? This is their gross sales, by the way. Up and down, up and down. It is so freaking inconsistent to the point where you might as well just slap me in the face and call me a racist because I don't like... Look at this. Since 2019, they've been burning cash on the books in order to keep the lights on. This is not a profitable business, which is pretty crazy to me. But again, I want to take a step back and remind everyone that Boeing, just like Intel, just like Ford, is a business enterprise that is too big to fail. America will never let them fail. Don't quote me on this, but if it comes down to it, they will bail them out because it's in the best interest of the United States to keep the lights on for Boeing. Likewise for Ford Motors, likewise for Intel. So even though they are a piece of crap financially and fundamentally, I do think they're not going to go bankrupt. Don't quote me on that, but what you can quote me on is that they're really ugly, hideous, and they've got hair in places that you shouldn't even have. Their free cash flow, oh my goodness gracious. You better take this away from the screen right now before I start losing hair. Negative $6.3 billion of free cash flow. That's just disgusting. So what I personally would do with the context of AI and everything in mind, I would eliminate this right off the bat, and I would personally replace it with my favorite defense military company, and it's Huntington Ingalls. They're in the business of building ships, carriers, submarines, and when you think about it, shipbuilding in the US prior to the Great Depression, dude, we used to have a huge chunk of the global shipbuilding market share. And now, dude, we're nobodies. Almost every ship is made in China, made in Korea, made in Europe. What I'm thinking is, with the current party that's in power, I think shipyards and shipbuilding is about to get a huge rehaul and money pumped right into their booty holes. I'm being serious. And this is one of the companies that's going to be responsible for that Renaissance movement. Quote me on that. Huntington Ingalls and General Dynamics. You take a look at their financial performance, dude, 85% into the grain. This is a company that I made video after video about. For the past year and a half on the channel, I kept saying, dude, I'm going to be buying and I'm buying big. And I did. I put my money where my mouth is. And it's paid off, okay? Year to date, 85% into the green. Take a look at their financials every single year without fail. Despite having human capital issues, they had this huge debacle a couple of years ago with the experienced people quitting on the shipyards, and then they had to quickly introduce new hires, but they're not skilled or experienced. So for them to be good on their promise for these defense contracts of saying hey, we owe you 5 ships, but because of our labor shortage, we can only do 2 ships. The company did go through kind of a sell-off and a scandal, but they're past that now. Despite the setbacks, every single year, they go up into the green. Positive year over year for their revenue and their gross sales. And unlike Boeing, if we take a look at their earnings per share, this is a lot more palatable and digestible. $8.36 in 2015 to now $14.50 of bottom line per share. Huntington Ingalls, and by the way, with Boeing, dude, I forgot to mention, this is a crucial sin that they have committed. Boeing used to be a dividend-paying stock. But do you know what happens? Because they're so unprofitable and such a mess of a business, during the pandemic, they cut their dividend and it never came back. In 2020 was the last time that Boeing paid a dividend, okay? Now, with Huntington Ingalls, did they cut their dividend? No. They're actually growing their dividend 3.4% year over year. So Huntington Ingalls would be my pick to replace Boeing. But if you're bullish with everything to do with aerospace, aircraft, and drones and whatnot, because of the whole AI optics in mind, my second pick would be Lockheed Martin. And this is a company right now, they're not having the best year, but if you zoom out and take a look at their total stock market history, 16,000% into the green. Okay, this is a dividend compounder with cheese, and I mean it when I say that, all right? Take a look at their financials. Again, unlike Boeing, every single year except, what is this one? Except 2022, up and to the right, a beautiful trend. And when we think about the F-35s that are going to be replacing the F-16s, they have a steady backlog of contracts to fulfill. Dude, their revenue is just only going to get bigger and bigger as we go forward. Because if you look at what's happening around the world, I think everyone is beefing up their military right now. Germany, Finland, Canada, Korea, everyone is beefing up the military, which includes the Air Force infrastructure of fighter jet planes. The F-35 is a game changer. Pause this video, open up a new tab, and look at some videos of the F-35, dude. It is horrifying. But on the other side, they're also so freaking cool. To be honest with you, you can't go wrong with Huntington, Ingalls, or Lockheed Martin. You can go wrong by doubling down on Boeing. Next one I want to talk about is Akamai Technologies, ticker symbol AKAM. I think they're in the business of like cloud security. And I'm going to be honest with you, for their forward trading multiple to be at 12, I can see why. If this is a recent pick, I can see why you jumped in. And on paper, it's not too bad, okay? Their revenue situation, it seems to consistently go up by a mid-single digit percentage, like 4% or 5% year over year. It's not bad. But what I do want to propose is the better alternative, in my opinion, that also happens to be undervalued right now is Fortinet. That's what I would go with. Yes, their trading multiple is slightly higher, but if you look at their stock market performance, they just went on a huge sell-off. And if you compare the numbers and the financials, I mean, with Acom, you're talking about 4% growth in their revenue year over year. With Fortinet, dude, 14%, 20%, 32% year over year change in their gross sales. I think it's a much higher quality cloud security business. That's just my personal opinion. Again, I'm not in the IT space, but from my elementary understanding, I'm more bullish about Fortinet. And if we take a look at their balance sheet, about $3.1 billion of cash and cash equivalents to that of their total debt of $1 billion. So if you pay off all of the loans and obligations on the books, they have $2 billion of cash left over. And if we hop on over to the cash flow statement, is it just as beautiful? Yes, sir. Look at the free cash flow situation. This is what I'm talking about. This Fortinet is a high-quality compounder. To see the free cash flow be increasing at a double-digit rate year over year like this, dude, sign me up. I'm going to be honest with you, after this video, I'm going to do a deep dive into this company because I personally might open up a position. And the next company I want to address is Campbell. Dude, it's like 4 p.m. here in Japan, but it's almost pitch black. And it's a food CPG that's in the business of selling canned soup, but also savory snacks. I get where the logic is at. It's a boring defense consumer staple. However, I think we're seeing a huge shift in the landscape of food CPG stocks. I think we're gravitating away from high preservatives and eating foods that have like 500 ingredients to that of fresh, local, and for a lack of better words, clean food. So what I'm saying is, we can't predict who's going to win in terms of the grocery store aisles, but why not just buy the platform in which the foods will be bought at? It's the exact same thought process with the AI infrastructure. The grocery stores, it doesn't matter what's on the shelves, the grocery store will still make money from those transactions, right? So if the grocery stores are going to transition from selling Kraft Heinz, Campbell, and General Mills stuff to that of more clean, fresh, and healthy products, they're still going to benefit from it, right? So I'm not going to say that Albertsons is the best company out here, but given the choice between them or Campbell or Kraft Heinz, I'd go with a grocery infrastructure stock, right? Albertsons. Personally, I feel like the better choice would be Amazon because the Whole Foods grocery chain has been ahead of the curve for the past like 20 years. They've been selling organic, natural foods since the beginning. And they're the parent company of that. So if not for AWS, if not for their robotics in their warehouses, Whole Foods, Amazon. And then the next one is Aptiv. They're in the business of selling like car supplies and parts. I guess the avionics portion of the dashboard and everything else. And I think the company itself is pivoting towards partnering with robotics companies and operations with autonomous driving. But I think that's an all or nothing bet because there's other players that are way ahead of that curve. So with the whole physical AI infrastructure play in mind, I would rather go with some HVAC stocks. I want to give a shout out to Aon. They're in the business of manufacturing equipment that cools down data centers here in the US. Tariffs, it doesn't matter. They're based in the US and they manufacture in the US, which means their margins are not as good, But if you think about the long run, strategically, I think they're in a good place. Because if the geopolitical tensions keep rising, I think Aeon's going to be a huge winner in the HVAC space. The next one would be Carrier. They're one of the biggest players in manufacturing air conditioners, heaters, everything to do with HVAC that's related to a data center. They're also going to be a part of that momentum and hype. And the next one I want to talk about is Perion Network. They're in the business of digital advertisements in the open internet. This is a company that is just really beat up. Taking a look at their financials, I think it makes sense. They're up and down because the business of advertising and marketing campaigns, it's not always printing cash. There's seasonality baked into it depending on the market cycle. And as you can see, since 2023, their gross sales, it's been dropping like it's hot. Shout out to you, Snoop Dogg. And if you scroll down and take a look at their bottom line, right, they're burning cash to keep the lights on. I think a better alternative, if you are bullish about digital advertisements, is going to be The Trade Desk. They do everything that Perion does, but just better, in my opinion. You take a look at their financials, again, like we talked about earlier. You tell me, I'll let the numbers do the talking. Does this look like a business that is hideous, that is atrocious, that is dying in the hands of AI or whatever speculation? Or do they seem to find a way to keep growing their top line at a double-digit rate? You tell me, right? You take a look at their earnings per share. Yeah, this is a very profitable company that is going head to head with Amazon right now. We'll see who comes out on top, but I honestly think there's enough money to go around for both of them, but that's an unpopular opinion. And if you take a look at their free cash flow situation, exactly. I just think this is a really high quality company. And I'm not just saying that because I'm invested into them, but if you're going to be invested into Perion, a digital advertising platform, I mean, best in class for the open internet space is The Trade Desk. If we talked about walled gardens, I would argue Google. Second place would be Meta. Third place would be Amazon. And the next one is AllianceBernstein. It's an asset management company. Not really a fan of them, okay? I think a better alternative that's also playing into the whole physical AI infrastructure would be a REIT. I'm kind of surprised that there's no REITs represented here, but I would say Digital Realty Trust. They're in the business of renting out data center warehouses. And the cool thing about DLR is that they're kind of on a dip right now. So me personally, I might be buying into them here in a little bit, but we'll see. My apologies. I think this is the better website when it comes to analyzing a REIT. So Digital Realty, their REIT score is 100. That's pretty impressive, right? They have no blemish. I mean, obviously their share price is getting demolished right now. Their trading multiple is a 21.4. So when it comes to a REIT, you don't look at the price to earnings, the PE ratio. It doesn't make sense because legally they're required to pay out at least 90% of that as a dividend. Instead, you look at their adjusted funds from operations, and that's what we're seeing right there. Dividend yield is a 3.1%. The crappy thing is because it's a REIT, it's taxed unfavorably, okay, at the ordinary tax rate. So that is something to take into consideration. Their payout ratio is 67%, according to their adjusted funds from operations. What's their occupancy rate? I'm assuming they went on a sell-off because the occupancy rate dropped. Yeah, 84.8% for a REIT. The golden standard is at least 90% of your real estate assets are rented out to a customer that's paying you rent. To have 84.8%, not a good look, and I wonder if it has to do with the Oracle data warehouse deal that just fell through. So to put that into perspective, they have 311 properties. So if we do some quick napkin math right here, 263 of their data center warehouses are generating money for them. But there's still a good chunk of the properties that are doing nothing. Maybe it's going through renovations or they're adding parts to it so it's not ready to go live. Their largest tenant makes up about 12% of their portfolio. All that to say, I'm not invested into them, but this one is on my radar. With Home Depot, I'm not really feeling it, because I think that's really contingent upon the home building and people having the discretionary funds to do home improvement projects. I know it's labeled as a defensive business enterprise, but I'm not really interested in Home Depot or Lowe's. I think if we're going to go into that sphere, like that way of thinking, I think the better alternative is laundry detergent, toothpaste. So Procter Gamble or Colgate-Palmolive, I think they're both undervalued right now, but that's also because value dividend stocks are really beaten up right now. Procter Gamble, I think it's a really high quality conglomerate. This is literally the definition of a sleep well at night kind of stock, okay? Same with Colgate-Palmolive, but I will argue this. I think Procter & Gamble's products are best in class. I think Colgate-Palmolive is like second or third, but it's more affordable and it's cheaper. Next time you go to Target, Costco, Walmart, wherever you go to do your shopping, compare the products. The Procter & Gamble ones, they usually cost like 5 to 15% more, the sticker price. But I think they're both pretty good choices. And if it were up to me, I would just delete Mattel and Constellation brands from the portfolio altogether. And I want to give a huge shout out to Watts Water. It's kind of crazy because this past week, I was doing my own homework and research. So I always like to investigate stocks and industries and see who's beaten up, where the opportunities are. And I was looking into Badger Meter. It's a company that's basically doing the exact same thing that Watts Water is doing. Another competitor is Roper Technology. And these three companies, they're in the business of providing the physical assets and the infrastructure to support the water utilities, water treatment centers, and everything else. So if you're bullish on water, but you don't want to invest into American Water Works, which is pound for pound the biggest regulated water utility company, because they just announced, I think back in October, that they're going to acquire Essential Utilities. So now their portfolio footprint's going to be the biggest. The alternative is the physical assets. I do have one of my tabs open right here that's looking into some other competitors. And another competitor is Mueller Water Products. So the physical infrastructure to support the water space. Now, I know a lot of words were said, and that was probably a lot to take in, but with the modified portfolio, I know it might be controversial and it might get me a thumbs down, but the portfolio scorecard, the quality of holdings, I think it would bump it up to the A tier. If the following companies were cut, the ones with the X, and replaced with the ones on the right, just what I think. But ultimately, as is, does the portfolio provide high risk, high reward from AI infrastructure bets and a defensive rate of return from boring compounders? I think it does. I mean, the ones that are highlighted in yellow, this one should also be highlighted, like Constellation Brands, just not it. Like those are the ones where I'm just not really a huge fan of, but it's just nitpicking on my end. To be honest with you, I wouldn't be surprised if this portfolio as it is, if the CAGR is around 16 to 18%. You actually, Bjorn, let us know, what is the performance of this portfolio? I'm assuming it's going to be in that ballpark. And to answer another question, is the barbell balanced? I think so. I think only time will tell whether or not you outperform the market for the long run and consistently, but based on what I see, not too bad. I mean, the ones that are highlighted, Boeing, dude, come on, you need to be highlighted as well. Besides these five, I think Bjorn's going to be all right. That's not financial advice, but it's hard to argue, right? Like Adobe, I really like that one. I love that it's your second biggest conviction play, because when we think about agentic AI, I think Adobe's probably one of the best players to reap the rewards from the creative side of the house. Because you could use AI to generate movies and videos and photos and whatnot. Adobe's going to be the biggest beneficiary from that. But then again, it begs the question, will the portfolio survive the test of time over the long run, especially macro downturns when everything seems to be on a sell-off? Well, if AI is really the next big thing, and I think it is, I mean, we've been seeing the momentum with AI for the past like 2.5 to 3 years, then I think you've got your bases covered. But having said that, I would revisit the quote-unquote safe sleep well at night side of the barbell, because I do think there's some room for improvement. As a refresher, these are the adjustments that I would make. I'm not trying to tell you what to do, but it's personally what I would do. And with that in mind, when we try to think about economic downturns or recessions, or when times get rough, people are going to still pay for their utilities. Obviously, there's like a small proportion of the population that's going to stop paying all their bills together, but that's an outlier example, okay? Don't be that smart, wise guy. People are going to be still paying for their utilities. Electricity, water, gas, what have you. People are still going to be buying groceries, and people will still brush their filthy little teeth and be doing laundry. So that's how I kind of like to think about what are the safe stocks, especially during an economic downturn. So that just about wraps it up. What do you guys think of Bjorn's portfolio? I guess I should go over here so you can look at it without all of my little suggestions. Do you love it? Do you hate it? Is it complex? Is it intelligent? Do you do the barbell strategy? Let him know. Give him some feedback. Obviously, it's my point of view, but I'd love to hear from the community itself. And before I sign out of here, what's going on in my personal life? So, obviously, I have ADHD. If you can't tell, I'm literally a textbook example of what it looks like when you're unmedicated. But anyways, classical music has been hitting differently these days. I've been listening to so much classical music, which I think is kind of funny because about a month ago, I think I mentioned it on the channel, I was really into Native American powwow music and Mongolian throat singing. And then before that, I was into Mexican mariachi music. I'm being serious. I would go on a 10-mile run listening to Mexican bands blasting their trumpets. And dude, it was a vibe. It was really good. But now I'm back to just zoning out to symphony music with like an orchestra, violins, violas, cellos. It's so freaking good. So after this video, I kid you not, go listen to Rachmaninoff. I'm not sure how to pronounce it, but his Piano Concerto No. 2. I'm telling you right now, it's like an out of this world experience, especially if you go out to walk your dogs while you hear it. It is so freaking good. Now, having said that, just as a reminder, if you want to give this a go, you want me to roast your portfolio, I promise you I will give you my time and effort. Give it a go by submitting it through the Google form link that's in the pinned comment. Now, having said that, I got to edit this video and get it up. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you really soon. It's pitch black here in Japan.